The pound fell sharply after the UK election resulted in a hung parliament, plunging the future of the country and Brexit into deep uncertainty. Here's a roundup of reaction from big investors and economists as well as their forecasts for the pound and UK stocks over the coming months. Sekun Usabe, Chief Executive of Hermes Investment Management. With hindsight, the decision of Prime Minister May to hold a snap election backfired spectacularly. A populist surge, similar to what we saw in the UK referendum or the US and French elections, saw voters respond to Mr. McDonnell's economic policies, and to Mr. Corbyn's authenticity. This combined with growing doubt about Prime Minister May's leadership, particularly since she was starting to be blamed for not doing enough to deter the terrorist atrocities in Manchester and London, delivered one of the most unexpected results in UK parliamentary elections in decades. Markets abhor both the unexpected and uncertain. The expected reaction is for both sterling to come down and possibly the FTSE, notwithstanding sterling's fall. We are likely to also see forward markets discounting rises in interest rates which will adversely impact the consumer in the short term as mortgage rates could start to rise further and faster than most borrowers budgeted for. Azad Zangana, Senior European Economist, Schroders. For the economy, households and corporates will be concerned by the increased political uncertainty. However, at the same time, the paralysis in Westminster will mean fewer changes to fiscal and economic policy. Despite this, we expect a pullback in household spending and business investment which will exacerbate the slowdown currently being experienced. The fall in the pound has been smaller than expected given the hung parliament. At the margin, lower sterling will push up inflation a little further than previously forecast, which will have a small negative effect on household spending. The Bank of England is unlikely to change its policy in the near term, but it will offer reassurance that it stands ready to act in the event of financial instability. Looking ahead, there is a high chance that any Conservative minority government may not last beyond a year. It will likely struggle to pass any finance bill. Paras Anand, Chief Investment Officer for Equities in Europe at Fidelity International. Whilst on first look, the result of last night's election may be considered a negative surprise for markets, it is arguably more instructive for investors to focus on the muted reaction across equity, currency and bond markets. The first point to stress is that whilst a hung parliament was not the specific outcome that many expected, asset prices in the UK and to a certain extent globally, already discounted a period of extended political uncertainty given the complexity of delivering on the outcome of last year's EU referendum. Simply put, that we are facing a period of political uncertainty is nothing new. Caroline Simmons, Deputy Head of the UK Investment Office at UBS Wealth Management. Given the lack of clarity on domestic policy and the impact on the Brexit negotiations, we expect sterling to remain soft. This should remain supportive of the equity market, under a Conservative minority outcome. However, should the market focus on concerns that a Conservative minority won't last and that we may ultimately end up with a Labour-led parliament, then the currency-related boost will likely be offset by concerns over the potential for increased corporate tax rates and nationalizations of certain industries. We expect the FTSE 100, which generates only 30% of its revenues in the UK, to outperform the FTSE 250, which has a more domestic exposure of closer to 50%. Eric Lonergan, Fund Manager at M&G Investments. The market response looks predictable. Sterling weakness is the focal point. This is consistent with the narrative that an increased Conservative majority would improve Brexit negotiations. This is not an argument I am convinced by, so I wouldn't be surprised if this weakness reverses. I don't expect much reaction from gilts or the stock market. The outlook for interest rates doesn't really change, nor does the outlook for corporate profitability. I am not convinced the outlook for Brexit changes, because I suspect that the European position is not really up for negotiation. There is still a material risk of no deal, And however low the probability of another referendum is, I suspect that probability has risen.